Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Cirrus Logic Inc. quarterly report. Cirrus Logic Inc. offers a diverse range of businesses and services that cater to various industries. The company's primary focus lies in developing mixed-signal processing solutions and audio products for global markets. At the core of Cirrus Logic's offerings are its audio products, which include amplifiers, codecs components, smart codecs, standalone digital signal processors, and SoundClear technology. These innovative audio solutions are designed for use in a wide array of applications such as smartphones, tablets, laptops, AR/VR headsets, home theater systems, automotive entertainment systems, and professional audio systems. In addition to its audio products, Cirrus Logic also provides mixed-signal products that cater to various industries, including automotive, industrial, and imaging. These products comprise camera controllers, haptic and sensing solutions, and battery and power ICs for smartphones. The company's extensive product portfolio is a testament to its commitment to innovation and customer satisfaction. Cirrus Logic markets and sells its products through multiple channels, including direct sales force, external sales representatives, and distributors. This multi-channel approach enables the company to reach a broader customer base and expand its global presence. With over 3 decades of experience in the industry, Cirrus Logic has established itself as a leading provider of mixed-signal processing solutions and audio products. Cirrus Logic Inc.'s stock price has seen a notable increase of 31.2% over the past year, driven by several key news events and positive financial results. One major factor contributing to this growth is the company's strong fiscal Q3 2026 financial results, which significantly surpassed analyst expectations for both earnings and revenue. The company reported adjusted earnings per share of $2.97, exceeding the consensus estimate of $2.44, while GAAP EPS came in at $2.66 compared to an estimated $2.03. Revenue for the quarter rose 4.5% year-over-year to $580.6 million, outperforming the consensus estimate of $534.5 million. This robust performance was primarily attributed to strong demand for components in smartphones and a favorable product mix. In addition to its impressive Q3 results, Cirrus Logic also provided optimistic fiscal Q4 2026 guidance, projecting revenue between $410 million and $470 million, which exceeded analyst consensus. The company's CEO highlighted the progress made in expanding its addressable market and diversifying its product offerings, including advancements in next-generation camera controllers and increased research and development investments in battery and power applications. The company's solid financial health has also contributed to its stock price growth, with consistent revenue growth of 4.5% over 3 years, high net and operating margins, and efficient cost management. As of the end of the quarter, Cirrus Logic held $1.08 billion in cash and investments with no outstanding debt, and actively repurchased shares for $70 million, showcasing strong cash generation and shareholder returns. Overall, these factors have combined to drive Cirrus Logic's stock price increase over the past year, reflecting the company's continued growth and success in the market. Cirrus Logic Inc. market capitalization of $6 billion is materially smaller than most of its industry peers of roughly $45 billion. Cirrus Logic Inc. trades at a lower price-to-earnings ratio of 18 times and a lower price-to-book ratio of 3.11 times relative within the industry. This makes the stock valued slightly lower than its peers in the industry. This likely suggests that investors are less interested about the company, or it could be that the stock have not caught up to the industry valuation and should further be investigated. The balance sheet appears very conservative, with liabilities representing only 16% of total assets. While this indicates low financial risk, investors should examine the composition and quality of the company assets to determine whether they justify the current valuation. Average liabilities have declined over the past 5 years, indicating improving balance sheet discipline and reduced financial risk. Shareholder equity has grown consistently, but operating income growth is weak or inconsistent. Equity expansion may be driven by financing activities rather than core business profitability. The company has consistently reduced its share count, while revenue and equity have grown, indicating disciplined buybacks that enhance long-term per-share value. The income statement shows that the company have been growing its revenue annually but the operating income have not been increasing. This shows that the business is under pressure with rising cost. The company comfortably covers its interest expenses through operating income and maintains a strong cash position relative to current liabilities. The primary drivers of revenue growth or decline can be identified through a thorough analysis of the extracted summaries. On the growth side, several factors contribute to an increase in revenue. The introduction of new products and technologies, such as latest generation audio products and high-performance audio codecs, drives sales. Additionally, stronger than anticipated demand for components shipping into smartphones and favorable market conditions also boost revenue. On the other hand, revenue decline is primarily driven by pricing pressure from key customers, loss or reduction in orders from these customers, and changes in customer relationships and agreements. The decline in average selling prices, ASPs, due to previously anticipated pricing reductions further exacerbates the issue. Furthermore, failure of key customers to purchase new products developed by the company also contributes to revenue decline. In summary, revenue growth is driven by innovation, market demand, and favorable conditions, while revenue decline is primarily caused by pricing pressure, loss of customer orders, and changes in customer relationships. The company's net income has experienced significant growth over the past year. In Q3 2025, net income increased by 20.9% compared to Q3 2024, reaching $140,310,000. This trend continued throughout the year, with a 27.8% increase in YTD 2025 compared to YTD 2024, resulting in a net income of $332,603,000. The profit margins have also undergone changes, albeit less pronounced than the net income growth. The gross profit margin saw a slight decrease in Q3 2025, dropping from 53.6% to 53%, but an increase in YTD 2025, rising from 52.2% to 52.7%. On the other hand, the operating income margin experienced a notable improvement in both Q3 and YTD periods, increasing from 26.2% to 26.3% and from 22.1% to 23.9%, respectively. The reasons behind these changes are multifaceted, with various factors contributing to the increase in net income and profit margins. These include unrealized gains on marketable securities, foreign currency translation adjustments, issuance of stock under option plans, repurchase and retirement of common stock, and stock-based compensation. While the exact causes may not be consistently stated across all pages, this summary provides a general overview of the key drivers behind these changes. The company is indeed generating positive operating cash flow, which is a crucial indicator of its financial health. According to the provided summary, the net cash provided by operating activities for the 9 months ended December 27, 2025 was $499,179,000. This significant amount indicates that the company's operations are generating sufficient cash to cover its expenses and investments. Furthermore, this trend continues into the first 9 months of fiscal year 2026, with cash generated from operations reaching $499.2 million. This consistent positive operating cash flow suggests that the company is managing its finances effectively and has a strong ability to generate cash from its core business activities. The company's debt level has undergone significant changes over the past few months. According to the extracted summaries, the total debt securities increased by $8,271,000 between December 27, 2025 and March 29, 2025. Furthermore, the total debt level rose by a substantial amount of $281,602,000 from one period to another. This indicates that the company's financial obligations have grown substantially. However, despite these changes in debt levels, there is no indication of a significant change in interest expenses. The provided text does not mention any notable increase or decrease in interest payments, suggesting that the company's interest expenses remain relatively stable. The performance of various segments and regions in the given period has been mixed. In terms of product segments, audio products and HPMS products have performed relatively well, with slight increases in sales. However, these gains are not uniform across all regions. Geographically, the rest of world region has been a standout performer, recording significant increases in sales for both 3-month and 9-month periods. On the other hand, China and United States regions have struggled, with declines in sales. The decline in the United States is particularly noteworthy, with a 42.2% drop in sales over the 3 months ended 2025. Management is optimistic about the company's future performance, citing strong operating results and growth. Net income has increased significantly, and cash reserves have risen by 47%. The company is also investing in high-rated securities with short-term maturities to maximize returns. In terms of strategy, management is focused on expanding into new markets and applications, driven by strong demand for the company's components in smartphones. This expansion is expected to exceed revenue expectations and provide growth opportunities. Management believes that the company has sufficient capital resources to meet its needs, citing future cash earnings, existing cash reserves, and available borrowings as sufficient to cover capital requirements. However, there are also risks and challenges identified, including the potential loss of key customers or significant reduction in orders, which could impact sales and profitability. Additionally, management faces intense competition for qualified personnel, particularly engineers, due to changes in immigration laws that may impair the company's ability to attract and retain talent. The company is also subject to tax liabilities that may be impacted by changes in tax laws. The company has been actively engaging in share buybacks through a share repurchase program authorized by its board of directors. This program was initiated twice, first in July 2022 and then again in March 2025. The total amount spent on share repurchases over these periods is substantial, with $344 million being the cumulative figure. The company's commitment to buying back shares is evident from the significant amounts allocated for this purpose each year. In fiscal year 2026, it spent $210 million, while in fiscal year 2025, it spent $161 million. These figures demonstrate a consistent effort by the company to reduce its outstanding share count and potentially boost shareholder value through this strategy. That concludes the financial summary for Cirrus Logic, Inc. Feel free to comment below, and I will be happy to answer them when possible.